2014, 97 countries signed an agreement that quietly ended a century of financial privacy, and almost none of the people it affected understood what had happened until their own bank called them. They were told, often in a short procedural phone call, that their account information was being transmitted automatically and on a fixed annual schedule to a tax authority on another continent. There was no request involved, no warrant, no negotiation. The account holder had no opportunity to object because the legal architecture had been built years earlier in the aftermath of a global financial crisis that left finance ministries hunting for revenue they suspected was sitting undeclared in foreign jurisdictions. For the better part of a century, the assumption among wealthy families moving capital across borders had been simple. Secrecy was a service purchased from a private bank, and that service would hold. It held, in many cases, for generations. Then it didn't, and the families who had built their entire financial architecture on the premise that nobody would ever connect the dots found in a matter of months that the dots had already been connected automatically by an institution they had trusted for decades. This is the story of the transparency trap. The moment a generation of wealth holders discovered that the secrecy their entire structure had been built on was never actually theirs to rely on. It was a courtesy extended by banking institutions for decades, and it was withdrawn by regulatory consensus almost overnight. What follows is the story of who saw it coming, what they did differently, and why the lesson has almost nothing to do with hiding money and everything to do with where you are legally rooted. Here is the number that should concern anyone currently holding assets outside their country of citizenship. More than 120 jurisdictions now actively participate in the Common Reporting Standard, the OECD framework that governs automatic exchange of financial account information, and the volume moving through that system now exceeds $11 trillion in reported financial account value annually. The framework was built deliberately in the years following 2008, when finance ministries across the OECD concluded that undisclosed offshore wealth was not merely a tax collection problem, but a structural threat to the credibility of domestic tax systems. Under the Common Reporting Standard, every bank account, every brokerage holding, every custodial insurance wrapper held by a foreign national is now catalogued by the institution holding it, matched against that individual's declared tax residency, and transmitted to the relevant tax authority without the account holder initiating or consenting to the disclosure in real time. The mechanism is administrative, not investigative, which is precisely what makes it so comprehensive. The era of the undeclared Swiss account, the Liechtenstein Foundation, that nobody back home knew existed, did not end with a single scandal or a single prosecution. It ended with a spreadsheet replicated across 120 national tax authorities, updating itself every year, whether anyone was looking for evidence of wrongdoing or not. Consider what actually happened to the holders of an estimated $4 trillion in previously undisclosed offshore assets in the years immediately following the rollout of automatic exchange. Voluntary disclosure programs across the European Union, the United States, and several Latin American tax authorities recorded a documented and sustained surge in filings between 2014 and 2020, as account holders made the calculation that disclosing voluntarily with reduced penalties was preferable to being discovered through a data feed their own bank was contractually obligated to generate. France alone reported tens of thousands of voluntary disclosure files in the years immediately surrounding the first Common Reporting Standard exchanges. A volume tax administrators themselves described as exceeding anything generated by traditional audit activity in the preceding decade. The pattern repeated across Germany, Spain, and Italy, each jurisdiction seeing disclosure volumes spike, not after an enforcement action, but after the simple public confirmation that automatic exchange was now operational. The Common Reporting Standard didn't only expose new information going forward, it retroactively exposed the accumulated decisions of decades. a holding structure that made complete sense under the privacy assumptions of 2009, became an acute liability by 2017, and nothing in the underlying tax law had actually changed. What changed was visibility, and visibility granted to a tax authority through an institutional reporting obligation is a one-way door. Banks do not unreport data. Jurisdictions do not withdraw from the common reporting standard once they've joined, because doing so would signal exactly the kind of opacity the framework was built to eliminate. This is the mechanical, structural reality sitting underneath the trap. Once transparency is institutionalized, it does not reverse, it only accumulates year over year across every jurisdiction that is signed on. The arms race of hiding wealth is over. The side with the data won. And the only logical path forward is not to hide your assets, but to relocate the jurisdiction that claims them. That restructuring runs through a single foundational concept, fiscal residency, not citizenship, which is a separate legal status entirely, and frequently confused with it, and not simply where you happen to spend most nights of the calendar year, but the specific codified determination made independently under each jurisdiction's own domestic statute of where you are formally a tax resident for reporting purposes. The overwhelming majority of high net worth individuals carry what amounts to an accidental fiscal residency, inherited passively from where they were born, where a parent opened their first brokerage account, or where a corporate relocation decades earlier happened to place them. Few have ever sat down and asked, deliberately, whether that inherited residency still serves their current asset base, their current income mix, or their current family structure. The Common Reporting Standard reports your financial account data to wherever that fiscal residency is currently registered with your financial institutions, full stop, regardless of how passively that registration came about. Change that registration deliberately through a documented lawful relocation of fiscal residency to a jurisdiction operating a territorial or remittance-based tax system rather than a worldwide income system. And the identical financial data that once generated a tax liability under your prior residency now generates none at all under your new one. The information flow itself never stops. And that's an important distinction from the privacy-based strategies of the previous decade, which depended on the data simply never reaching the authority in question. What changes under a deliberate fiscal residency strategy is the destination, and the destination under this framework is what actually determines the consequence. This is also why the timing of a residency change matters as much as the jurisdiction selected. Since most tax authorities apply specific day count and center of life tests that determine the exact date a change becomes legally effective, and a poorly timed transition can leave an individual straddling two residencies for an entire reporting year. This is where the analysis has to deepen, because fiscal residency by itself is necessary but not sufficient, and treating it as the complete solution is precisely the mistake currently being made by a large share of wealth holders who consider themselves already protected. The second pressure point now converging on global wealth is the taxation of unrealized capital gains, a policy mechanism already enacted in limited pilot form within several G7 adjacent economies and under active public legislative review in multiple others, including proposals that would apply specifically to individuals above defined net worth thresholds rather than to the general population, where the common reporting standards solve for hidden income and undisclosed account balances. Unrealized gains taxation addresses an entirely separate governmental anxiety, namely wealth that compounds and grows substantially in value, sometimes for decades, but is never sold, and therefore never triggers a taxable event under conventional, realization-based capital gains rules. This is precisely the mechanism by which a great deal of multi-generational wealth has historically grown largely untaxed, held in appreciating securities, private equity, or real estate that simply is never liquidated. A jurisdictional structure built around residency and income reporting alone is structurally incomplete if it fails to account for how, and critically whether, the appreciation of your existing asset base itself becomes a taxable event under the rules of your chosen residency, particularly for jurisdictions that calculate liability on a mark-to-market basis at year-end rather than waiting for a disposal event. Wealth holders treating fiscal residency as a single variable problem, solved once and left alone, are already a full regulatory cycle behind where this is heading, and the jurisdictions currently most attractive on a pure income tax basis are not always the same jurisdictions positioned to remain favorable once unrealized gains taxation becomes more broadly adopted. Here is how this translates into something actionable, and it unfolds as a sequence rather than a single transaction or a single filing. The first step is an honest, comprehensive audit of your existing fiscal residency status, including any residencies you may hold without realizing it. Since unintentional dual fiscal residency is the single most common source of unexpected common reporting standard exposure among individuals who believed their structure was already clean. A family that relocated for work 15 years ago, opened local accounts, and never formally severed ties to the original jurisdiction may discover that two tax authorities both consider them residents simultaneously, each receiving the same common reporting standard feed, and each asserting a competing claim on the same income. The second step is a genuinely comparative jurisdictional analysis conducted not on the basis of headline tax rates published in international rankings, but on the specific treatment each candidate jurisdiction applies to foreign-sourced income, to capital gains, and to the particular asset classes that actually make up your portfolio. Since treatment varies meaningfully by asset type, even within a single jurisdiction's code, a territorial system that exempts foreign-sourced dividends may still tax foreign-sourced rental income differently, or treat a privately held operating business in a third country under an entirely separate set of rules. The third step, and this is the one almost universally skipped by advisors operating on outdated playbooks, is a forward-looking assessment of each candidate jurisdiction's policy trajectory, specifically on unrealized capital gains taxation, weighed against the trajectory of your current one. A jurisdiction that looks structurally favorable today, but sits 2 budget cycles away from adopting some form of wealth or unrealized gains. Taxation isn't offering you a durable structural solution. It's offering a temporary discount with an expiration date. Nobody has printed on it yet. And the families who treat fiscal residency as a one-time decision, rather than a position requiring periodic review, are the ones most likely to be caught flat-footed by the next legislative cycle. The transparency trap was never really about transparency itself, despite what the name suggests. It was about an entire generation of wealth holders mistaking financial privacy for the asset actually worth protecting, when the asset that mattered all along was jurisdictional control, the deliberate, fully lawful choice of precisely which sovereign legal framework governs your wealth, your income, and increasingly the unrealized appreciation of assets you have no intention of selling. Common reporting standard data exchange made privacy as a strategy functionally obsolete within a single regulatory cycle. It did not make sovereignty obsolete, and that distinction is the entire thesis of this series. The wealth holders building genuine structural security in this environment are not hiding from the system that emerged after 2014. They are choosing, in full legal transparency and with complete documentation, exactly which system they sit inside, and doing so before the choice is made for them, by accident of birth, by an old brokerage account, or by a tax authority's spreadsheet. That deliberate choice, fiscal residency, engineered by design, rather than inherited by accident, is the actual structural inheritance this generation of global capital needs to plan around. And it is a decision that compounds in value the earlier it is made. In the same way, an unaddressed liability compounds in cost the longer it sits unexamined. In the next episode, we go inside the specific jurisdictions currently making that architecture possible in practice. The documentation each one actually requires to withstand scrutiny under the common reporting standard, and the structural mistakes that turn a sound plan on paper into a brand new liability in execution. Join our community of informed investors
to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.